Welcome back to another episode of Retired Right. I'm Ryan Wyatt, and today I'm joined by the titans of technical analysis.
That's a good one.
Ron Wyatt. I've been thinking about it for a couple of days. Ron Wyatt and Nick Lewandowski, both members of the investment committee here for Wyze Wealth, and both wealth advisors as well. The episode, or the topic for today's episode, is long-term expected returns relevant to 2025. So these are like 10-year expected returns. So per usual, we're going to explain why that matters, how we would interpret that type of data. Nick's going to pull up a graph during the episode, and we're going to walk you through a couple things on there. Talk about, whether there's a asset class in particular on the graph that we also use that looks pretty attractive over the next 10 years. And then from there, we'll kind of wrap it up. But like I said, I just want to start, educational in nature. And whoever wants to take this first question, feel free. But why do you think it's important to look at the long-term market outlook?
Yeah, Nick, if you want to handle that, I just want to add something before we get to that. About how it's calculated. I think it's somewhat important. Okay. So the bond market's really easy. If you so we're looking at expected returns over a 10-year period. So let's just say you buy a treasury bond that's yielding 4.5%. Well, your return over 10 years is 4.5%.
Okay.
So in general with bonds, you can primarily use the current yield. If it's a shorter term bond that will, mature, you have to reinvest, then you also have to put in the impact of inflation. Could inflation go up or down? If inflation goes up, the yields go up, so your expected return goes up. Okay, so bonds are really straightforward. Stocks, a little bit more complicated. What you're doing is you're starting with...
Wait, before you get into stocks,
Sure.
I have one question on the bonds. So there is kind of like a fluctuating component to the expected returns, and that's derived around inflation.
Inflation, yes.
Got it.
Largely,
So
right.
as that goes up, you would expect the expected returns go up because we've done episodes on this in the past, but interest rates are going to kind of trend positively with inflation. So that's where you could see the expected returns
change a little bit, right.
for bonds.
Exactly.
Got it. Okay. Then you were going to go into stocks?
Yeah,
Nick,
keep going.
Okay.
So with stocks, as I mentioned, it's a little bit more complicated. So you start with the dividend yield that's being paid, and you assume that continues. Then you also have the earnings growth component, right? So if you have earnings, that means the company's profitable, and then you look at the growth of the earnings. So if there's growing earnings, that means that the company can increase the dividends, it can reinvest in itself, it can buy other companies, so it can grow. And then lastly, you have valuation. Are the companies cheaper than normal? Then there's a regression to the mean, which means that they might pick up some excess return going from cheaper than normal to normal.
Okay.
On the other hand, if the market's really expensive, like it was in January of 2000, then there could be a regression to the mean from being really expensive going down, which would hurt return. And so when you look from January of 2000 for the next 10 years, the S&P 500 actually lost about 1% per year on an annualized basis.
Okay.
Not just like 1%, 1% a year, which is unheard of.
What was the first measurement that you said? Was it dividend
Dividends,
yield?
right.
Okay, so to me, that sounds like you're talking about dividend yield. I'm going to associate that with one individual company. And you're talking about earnings growth. Again, I'm thinking that's earnings growth of an individual company. So how are they
the market
so how are they looking at, is it like an average earnings growth across companies in the market? Mm-hmm. Okay.
They have, if it's the S&P 500, there's a bunch of analysts that have estimates for each of the companies, and they aggregate it into the market.
Got it. So this is okay. So this is for the overall market that you're looking at.
Right.
Now, how are you guys using this data?
Yeah, so when you think about what we do, the highest level of what we do on the investment side is thinking about the strategic asset allocation for our portfolios. And that's not thinking about like whether we own a particular stock or a particular fund or ETF. That's thinking about how much do we have in US stocks versus treasury bonds, et cetera. And so by looking at this data, we help weigh all those assets against each other and then understand how we want to own them in proportion to each other based on their expected returns and risk.
Now, are you guys like, do you just have all the time in the world and you're doing this on your own, or are you kind of piggybacking on research of, larger institutions? And if it's the latter, how much weight do you put on the research that other institutions are kind of delivering to you?
Before I answer that, I just want to come back to your original question about how do we use it, because I think that's important. And so how we use this is, first of all, we call capital market assumptions. That's 10-year expected returns in our planning software.
Cool. Okay.
So expected returns are higher, it's easier to achieve your goals than if they're lower, right? Mm-hmm. So we might have to adjust plans accordingly. The other thing is that when we meet with clients oftentimes, want to know what expected returns are, and we can explain that to them so they have realistic expectations. Like if the market has normally done a little over 10%, but the market right now is very, very expensive, we have to share the bad news that, hey, the expected return's a little bit less than normal, and so that we. Again, it's in the plan so that they know it and we're planning for it.
That's a really important point. I'm going to ask you a follow-up question, then I want to make a point. What, off the top of your head, just like U.S. large company stocks, what do you think the expected return is over the next 10 years?
What's it, around 7 something?
What is it? I'm looking it up right now on the data that we have. It's 6 and some change. It's just over 7, actually.
Okay, just over 7.
Is that for large caps, or is that
U.S. large cap?
Okay, so just over 7. That's expected return. Right. If you look at historical return, you would, for large company U.S. stocks, you would probably average a rate of return over just over 10%.
Over 10%, right.
Why that's important, and this is really just a note for, I guess, if anybody out there is, working with an advisor and they're, planning with that advisor, you really want to make sure that you know what return assumptions are being used in the plan. Our personal belief is that we don't want to paint a rosier picture than is reality, and so we use expected returns in our plan. If our clients can meet their goals by us using the lower return numbers, expected returns, then they're in really good shape. We would never sit there and use historical returns, which really aren't accurate of what the next 10 years are going to be, just to show them a higher probability of success. Because that's when you can start to, if you do that for long periods of time, that's when you can start to kind of fall into some traps of maybe overspending when you shouldn't be, et cetera.
Let me add to that. So back in the late 90s was one of the most difficult times because my process did not get carried away with the tech, with tech stocks, okay? So I'd have potential clients come to meet me, and in my planning software, I used, modest, realistic returns, and some of my competition, because the S&P had been doing, I think it was like 3 years in a row over 20%,
huge,
and I think there was some like 30% years. So people, there was a poll done for people, and I think the expected returns for the S&P going forward, the S&P 500, was somewhere around 12 to 15%. So my competition was using really rosy projections, and I wasn't. Now I ended up being right, but sometimes they'd get hired because their plan looked better. Well, of course, their plan's going to look better if they're assuming a 15% return and I'm not.
Which is scary because it's either one of two things. They're doing it and they know they're doing it, or they don't know they're doing it, which is even...
It's hard to know which one is worse.
Incompetence or deception. Deceptive, right?
To me, that's just terrifying.
Yeah, so we always want to use realistic returns in our plan.
Right. And I think for the most part, our clients resonate with that. Right. They understand why we're doing it. All right. So then back to the question that I asked. So, is this research that you guys are doing in-house, or are you piggybacking off other research from other firms? And if so, how much weight, whether you're doing the research or not, how much weight are you guys putting on this?
So in terms of how we derive it's a little bit of both. So if you think about our industry, like there are tons of institutions out there, and they have armies of analysts who sit in their little analyst cubicles, like pounding away at these numbers. And like generally they kind of all converge on like roughly similar averages with some outliers here and there. So we basically take a survey of all that data, and the ones we actually put in the software right now and use in the charts that we show are specifically from JP Morgan's Capital Market Outlook. However, we look at those numbers in reference to like other sources as well and make sure that they're not like an outlier.
Got it. Yeah.
Is specifically where the data is coming from. And then like Ron was talking about, we have these methods just from understanding like sources of expected return to kind of, you know, assess whether we think those expectations are realistic or not. So if we were looking at JP Morgan's assumptions and they stopped passing the smell test in terms of like, well, starting yields are here, why is your fixed income expectation here? You know, we would go a different direction.
Got it. So basically, just because you're using external research or numbers or data, whatever you want to call it, that doesn't mean that, like, you know, your job's done. There's no additional thought that goes into
Correct.
it. Okay. So I know one thing that we always talk about is, I mean, I think any episode that we've recorded on this podcast where we talk about investments, we always say we don't have that crystal ball, meaning we and nobody can predict what's going to happen in the markets. So does that contradict using 10-year forward-looking expected returns?
So I don't think it contradicts it, because if you look at studies and you look at the framework that's being used, and if you applied that to previous periods, okay, so in general, when the market's more expensive, the future returns have been less. And when the market's cheaper, the future returns have been greater, like for the stock market, for example. And so there is a lot of academic research that validates what's happening, that not the return next year or the following year, right? But over a longer term, you know, dividends, yields, growth, all that really is within a range, somewhat reliable.
Sure. And it's, you know, I think I wasn't in the industry at the time, but the tech bubble, just from, you know, reading about it, studying it, same thing kind of happened there. As the market grew and grew and grew, forward-looking expected returns became lower, and then essentially that's kind of what has happened over the past couple of years that we're in right now.
Yeah. So what happens, though, here's the problem, is if you look at a lot of the research analysts, right, or a lot of the large firms that dedicate resources to expected returns, as something gets more expensive, their prediction, their expectation is, you know, less returns. But the public, for the most part, as you know, the stock market does very, very well, like in the late 90s, then they expect it to continue. And when the stock market does very poorly, they expect that to continue. And it's short term, that might be the case, but longer term, there's reversion, as I mentioned.
Okay.
The other thing I want to emphasize is that when we do make adjustments, and I'd like to use the word adjustment here because it has that connotation of like incremental, it's not like Ron and Nick woke up on Tuesday, pull down the latest capital market assumptions. Oh no, yields are lower, so we sell all the treasury bonds.
Right.
You know, it's a process of, you know, really we do it comprehensively once a year, and we're kind of looking out over that long-term horizon, and it's kind of like, okay, like strategically, do we want to shift incrementally here, incrementally there? It's not this like day-to-day thing, which I think is what more people think of as the crystal ball approach.
Right. And at some point, did you want to share some of the expected returns of the different asset classes?
So I was
headed there.
Yeah,
Okay,
so what I want to do is, I know we have a graph, and we'll pull that up on the screen now for those of you watching on the YouTube channel. Why don't you guys just explain like what's going on the graph
I'll let
first?
you take that.
Okay.
And then if I feel like maybe we didn't cover something thoroughly enough, I'll just ask you to define what we're looking at.
Sure, yeah. So if we have the graph up, whenever we have it up, this is just a graph of the assumptions that we're currently using. Again, we are pulling these from JP Morgan's 2025 capital market assumptions.
So this is from 2025 over the next 10 years.
Over the next 10 years, you can look these up yourself online if you would like. It's a very riveting PDF document, about 30 pages long, maybe longer actually. But so that's where the data comes from. And what you see here is a chart, and on the y-axis, so the vertical axis, is the 10-year expected return, and then on the x-axis, the horizontal axis, is the risk, which is the standard deviation, is the specific measure. That's a statistical measure of the up and downness of the return stream, right? So if returns are really volatile, really high standard deviation, that means it's a riskier asset.
Okay,
basically.
got it. So like if you're looking at on the graph, if you're looking at cash, it's on the left end of the graph. X-axis is standard deviation, or the risk measurement that we're using.
Mm-hmm.
So that's low risk, obviously, and then maybe something up like on the right side of the graph, emerging market equity. You're saying the standard deviation there is maybe 21, 22. That's more risky.
That's correct.
That basically means, and correct me if I'm wrong here, but standard deviation basically means how far typically fluctuates from its mean return.
Exactly.
That's correct.
So one thing I wanted to add is you'll see a line. It's called the capital market line, and it goes from cash. We consider that to be the riskless asset,
Right.
to the risk asset. In this case, what we often use is U.S. large companies.
Got it. And so it's creating a straight line, and you can see that on the graph. It's going straight from cash through U.S. large cap stocks.
So theoretically, anything above the line has a very attractive return to risk ratio.
And what do you mean by that? And like two things, I guess. Why above the line, and what do you mean by risk return trade-off?
So what you would like is to be in the upper left quadrant, right? So that means the return is high,
Okay,
and the risk is low. That's like the investment everyone in the world wants. So take a look at, for example, private debt. Private debt and private equity probably have the two assets that have probably the most favorable trade-off between the return that is expected compared to the risk that's expected. Okay?
Got it. Yeah.
And so that's all it is. So, and by the way, we do own private credit and also private debt.
Okay,
for our
got
clients.
it. So just taking it one step further, so looking at private debt compared to U.S. large cap stocks, obviously it's higher up on the y-axis, meaning the expected return's higher. But if you notice, it's closer to the left end of the side, so the risk is lower than large cap stocks. So what that really means is higher expected return with lower risk, better investment opportunity, and for purposes of this conversation.
Exactly. And the one that we're using now, the company we're using, I don't need to get into the name necessarily, but the current yield is approximately 10%. Now that yield could come down a little bit, but that yield is much more attractive than the expected return of stocks.
Okay. All right.
U.S. large company, right?
Nick, anything else you want to add?
Is there a couple other assets you wanted to?
No, yeah. If we want to talk about a couple other assets, I mean, I think another thing that we see on here that can be a big topic of conversation is, in general, like developed market equity, which is called EFA equity on this chart, is generally expected to be a little more attractive than U.S. equity. So it plots a little higher on this chart, a little riskier, but higher expected return. And a lot of that is related to the fact that U.S. large stocks in particular are overall as a market expensive relative to historical assets.
And if you look, for example, also at like long-term bonds, they're basically right on the line, kind of seem fairly valued in this environment. If you look at U.S. small stocks and emerging market stocks, they have higher expected returns than the U.S. large, but of course you can see they're more risky too.
Got it. And so then I guess one other question that I came up with while you guys were talking was this risk return trade-off conversation. That's really like that's a comparison. You're comparing different asset classes against each other.
Absolutely, right.
And the one that has the more favorable expected returun with lower risk has the better risk-adjusted return trade-off.
Exactly.
Yes.
Got it. And then under the graph, under the red line would mean stay away.
Run away.
Well, the other thing that's important, though, that this graph doesn't capture, which when you translate this into a portfolio, it does matter, is how they function in a portfolio, the correlation between the assets is another statistic, and that matters when you start putting things together into a portfolio. So theoretically, even an asset, like I'll just pick on emerging market equity here because it's below the line. U.S. small cap is below the line too. It's below the line right now. It seems like not to offer a favorable risk-reward trade-off, but especially with emerging market equity, those stocks aren't as correlated. They don't move identically to U.S. stocks. So even though returns are a little lower, there's a diversification benefit that they potentially offer relative to just owning a total U.S. portfolio.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewealthadvisors.com or call 724-271-7019 to get started. That's 724-271-7019 to get started.
So I guess why not, expected returns for private equity, private debt. Nick, you mentioned some international equity. Why not just say, hey, look, that looks better than large cap stocks right now, looks better than small cap US stocks right now. Why not just overweight those? I know we have certain factors of high expected returns that we favor, so why not favor those asset classes if you think they're going to do better?
Well, I think there's two things. There's the emotional element of it, and then there's also, and I'll get to that in a minute, and there's also the other element, which I'll let you cover in a minute. But so what happens is let's just say in the late 90s, as I mentioned with the tech bubble, this happened to me. So people would come to the office and want to put more and more into tech, right? And let's just say that I had no tech exposure in 1999. Mm-hmm. That might have been the right thing to do, right?
Right.
Assuming that non-U.S. stocks, small stocks, value stocks had higher expected returns. But if I would have done that, say in 97 and 98 and missed a lot of the run-up, I'd probably been fired before I could add any value.
Got it. Okay.
And so what happens is if you go to the extreme, you might be right, but are you right in time for people emotionally to stick with the program? Do they have strong enough belief to stay with the program when their portfolios are lagging? Now, if they would have waited 2 or 3 years, it would have worked out incredibly well because those assets were expensive, and if you look over the next 10 years, they really did underperform.
Is there any world where you maybe adjust the weightings, like focusing just on the equity side, you adjust the weightings? We're saying, hey, instead of maybe being at 30% or like a third in international, maybe bump that up a little bit?
Yeah, that's basically what we do. Like,
okay.
I'm not commenting on current percentages, but that's the kind of thought process we go through.
Got it. Okay.
Exercise. There's one thing I really want to say. Ron was talking about at a high level, but with a private asset specifically, the reason that you don't want a portfolio that's like 50% private equity, 50% private debt, on this paper they look great, but it's not liquid. So if you need to draw on the portfolio, you'll get some distributions off the private debt, maybe off the private equity too, but you can't readily sell out of those things completely if you need to create additional cash. It's hard to rebalance the portfolio. So you don't want to just be like, hey, oh, that looks great, because the portfolio becomes completely illiquid then.
Got it.
Right. If you look at the design of our accredited portfolios, now accredited means that an investor has to have basically $1 million in financial assets, excluding a home. There's about 20% in private investments in our balanced portfolio. We think it's enough to add value, but as Nick said, not so much that we can't move around because they're less liquid.
Okay. Now, the other thing that I noticed when looking at the graph is when you look at bonds specifically, intermediate treasury, long-term treasury, private debt, they're scattered all across the board. Now, I know the way that our portfolios are set up, we really have private debt in there, and for the accredited portfolios, private debt and intermediate treasuries. That's kind of like the two primary holdings there.
Right. Well, so the one private debt is for accredited only, but the primary one is not for accredited, so we use that more broadly. But yeah, we use basically the treasuries for liquidity and safety, and then we use the private debt for yield enhancement. What we're really trying to do with our bond portfolio is have less price fluctuation and more income.
Okay. So because this is just taking individual asset classes, but if you took like our portfolio, how would that stack up on this graph, you think?
You're probably looking at an expected return similar to what high yield and leverage loans show on here, but with a little bit less risk, if not a lot less risk. So that's what Ron was getting back to, where the treasuries are there for safety, the private debt is there for the yield enhancement and the income. And when you put them together, you get a really powerful combination of protection from the treasuries with income, the private debt, that we think is superior than going out and just buying high yield bonds for extra
Or
return.
corporate bonds or whatever.
Bonds, yeah.
I mean, the yield right now of the portfolio, probably 6.25%.
And if you were just investing in like, let's say 100% intermediate treasury bond portfolio, what do you think you'd be at there?
4.5, 4. Like the
Okay.
10-year treasury is around 4.6 right now. Yeah.
Okay.
On these numbers, for long term.
Yeah.
Got it. Okay. Anything else that you guys want to add?
No, the strategic part, like we can get into that a little bit in a little bit, like the allocation.
Yeah. Why don't you go ahead? Whatever you want to share on that part.
So we get questions all the time, is saying, okay, so, kind of like you alluded to before, these expected returns are greater. What are you going to do about it? Well, first of all, with rebalancing, and the concept of rebalancing is you have a certain asset class that you have a certain allowable range. Let's just say you're targeting 20%, and maybe you allow it to range between 16 and 24%. Okay, that's like the normal range. So if an asset starts getting expensive and gets out of the normal range, we trim it down and put it to the more inexpensive. So our system of monitoring portfolios is already taking advantage of these sell high, or I should say trim high and then add low. So we're already doing that under the hood. Okay.
Got it.
And so we don't have to have a crystal ball because of our process. The second thing is so we don't have to make these huge bets. Okay?
Right.
The second thing is with our stock strategy, we have one belief, but a couple ways of implementing that belief. We can do it with ETFs or with individual stocks. And both of them, what's happening is that when one sector, say tech stocks in the late 90s, get expensive, we'll slowly start to become underweight them, okay? On the other hand, if a certain sector like tech gets cheap, okay, before the tech bubble or many years afterwards, we'll start to overweight that. So it's a dynamic process that happens automatically. Because those two things are working, we don't have to make these, as Nick alluded to before, these big shifts back and forth. Now and then we may tweak something based on expected returns, but that's not often at all. And if it happens, it'll be more moderate.
Got it.
I just want to give a couple quick bullets, because in meetings, clients will often ask us, what are you doing with the portfolios? And a lot of times it's boring because it's very incremental and it's just kind of telling them the same thing. But if you want to think at a high level, like the big themes that I think we have, we do think that private debt and private equity offer very attractive risk-adjusted returns. So being mindful of liquidity and being mindful of client circumstances where it's appropriate, we are integrating them into portfolios for the benefits they offer. We see long-term expected returns for the U.S. large caps, like we talked about before, a little lower than developed international. So we are, even though international has had a tough run, we're sticking with our international allocation, but for the emotional reasons Ron said, we don't have an overweight to it or anything like that.
Yeah, what's very interesting is, I'm sorry, let me just pick up on this.
Sure.
So our stock strategy is pretty dynamic. A couple years ago, the allocation to non-U.S. stocks was only about 20%. Okay? U.S. stocks were more reasonably valued. Now, since then, U.S. stocks have really run, much more so than non-U.S. Right now, our stock portfolio is over 35%, and if some
International?
non-U.S. stocks in the percentage of the portfolio is over 35%, potentially closing in on 40. Now, why is that? It's not, again, because I have a crystal ball. It's just because I'm looking at, trying to find ideal companies. Reasonably valued, very profitable, low risk, and expected good growth rates.
Got it.
Okay, very common sense, and is pointing me now more and more towards non-U.S. markets, which again a couple years ago was not.
All right, so then let's wrap on this question. You're sitting down with a client and they tell you, I just really don't like investing in international companies for whatever reason. What do you, like, how do you explain the benefits of it, or what's your kind of argument for why it should be in the portfolio? And I know that you've probably in a lot of ways made that point already, but maybe just kind of simply summarize why.
So if someone was absolutely adamant, so first of all, we would try to educate, right, of why it makes sense. Nick alluded to this before, right? So there's an increased opportunity set. Instead of just the U.S., then you increase your opportunity set. Also, there's a diversification benefit, and studies show that that by adding international, the risk, the total portfolio risk isn't necessarily higher. And in certain periods of time, you can get better returns. So those are the educational reasons. But if someone said, absolutely don't want to do this, we can customize a portfolio that doesn't have it, okay? We just want to make sure that if we make that change, that we, again, educate the people about what it means to them, and we have to make sure that that change will still allow them to meet their goals. If it doesn't really do it, then we explain the trade-offs and what we need to do. Do we have to cut your income? Do you retire later? So it's an educational process.
Sure.
Right now, we're not hugely committed to international by any means, but we don't have one client. All of our clients have globally diversified portfolios with a huge major U.S. bias.
So the diversification benefit, what does that do? Does that smooth out returns? Does it actually increase returns?
It smooths out on paper the math. It's back to that correlation thing I talked about. Because they don't move in perfect tandem, mathematically it smooths out the returns. One of the sources of that relationship, of the less correlation, is currency differences, right?
Okay.
So, different international companies tend to earn revenue in local currencies or different currencies in the world. Some U.S. companies do, but then when you're going from those prices to the U.S. dollar, the currency effect also has an effect alongside what the company's share price is.
Okay, so smoother returns, so let's think about it in a real life example, right? Say you're starting from our office here and you're going to downtown Pittsburgh, right? There's a bunch of different ways that you can get there. You can take the highway down, that's probably the straight shot, the easiest. That would be the smooth returns process. Or there's the going through the suburbs, weaving, kind of that might be the putting all your eggs in one basket, a lot of volatility, kind of roller coaster. But at the end of the day, you're going to end up in the same place. So does diversification do anything for investment returns? Is it better from a portfolio management standpoint to fluctuate less and stay kind of closer to that capital market line that you see on the graph?
Or
not necessarily?
Let me just.
Or is it just easier to stomach because it's less? There's less fluctuation.
I'll look at two time frames, but in general, as Nick said, if you look at the math, there's a diversification benefit, and so long term that should help smooth out returns, and it could potentially help also with returns, because if you're rebalancing as one market gets expensive, if you trim that down and buy an inexpensive market, as long as it's if you're dealing with good asset classes, that inexpensive market typically comes back, so that can help returns.
So there's kind of an efficiency component to it, like the diversification and rebalancing along the way that can help with returns, is what you're saying.
Yeah, and then. But what investors have to know is that these trends can last really long. So,
trends of what?
Well, returns. So, if you look in the late 90s, U.S. stocks were doing the best, and then within U.S. stocks, it was large stocks, and within large stocks, it was tech stocks, right? So everyone was flocking to tech, and got very expensive. So. A lot of portfolios then were globally diversified, and for the next 10 years, as I mentioned, starting in January of 2000, the S&P gave negative returns, where small stocks did well, non-U.S. stocks did well, value stocks did well. And so, of course, then people migrate to those, and then from 2010 till now, U.S. stocks have done better, So it's hard to predict these long-term trends. So have some to have some non-U.S. stocks to add value, but not so much that you can't stick with the program.
Okay. You guys have convinced me. I'm going all international, all private debt, all private equity. I'm hitting a home run. Third. But no, I appreciate it. I think that this was a really informative episode. For those of you listening, hope you enjoyed. If you like the show, feel free to subscribe. Check out our website, wyzewealthadvisors.com. That's WYZE wealthadvisors.com. If you're interested in, further exploring our services or our kind of investment beliefs, all you have to do is click on the free Retire Wyze assessment. We have a simple 3-step process. Starts with a 20-minute call just to see if there's a good fit, and if there is, 2 additional steps to really take a deep dive into kind of what we do for our clients. At the end of that process, we actually give you a printed retirement assessment that you can keep. Thanks, guys.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.